Hello friends, we were discussing about adjustment of capitals in admission of a partner. Adjustment of capitals. In the last lecture, we started with method 2, where the new partner brings capital according to the capital of old partners, so that the capital of all the partners is proportionate to their share of profit. In the method 1, we used the new partner's capital as the base, but in the method 2, the new partner's capital is not given. We have to calculate it, and the amount should be such that the capital of all the partners in the new firm is proportionate to their share of profit. Clear? For that, we used the old partners' adjusted capitals as the base. Adjusted capital means the capitals after all the adjustments relating to old partners. All adjustment means adjustments relating to goodwill, revaluation of assets and liabilities, and treatment of reserves and accumulated profits and losses. Clear? So now in this lecture, we are going to do a practical problem on this method 2. With this, we will wrap up this chapter of admission of a partner. Right? This is the last lecture for this chapter. Let's see a practical problem. A and B are partners sharing profits and losses in the ratio of 3:2. Their balance sheet as at 31st March 2016 is as follows. See the assets, machinery, furniture, investments, stock, debtors, provision for doubtful debts, and cash. On the liability side, we have the capital accounts of A and B as 70,000 and 60,000. These capitals are not the adjusted capitals. Adjusted capital means the capitals after all the adjustments relating to revaluation, reserves, goodwill. Clear? Then we have the general reserve of 20,000. You know how to treat the reserves. Bank loan of 18,000 and creditors of 72,000. It further says that on 1st of April 2016, they admitted C for 25% in share on the following terms. Clear? 25% share means 1/4 share. C brings in capital proportionate to his share after all the adjustments. It is not given how much capital he is bringing. It is just given that C brings in capital proportionate to his share after all the adjustments, and rupees 8,000 for premium for goodwill out of his share of 14,000. His premium for goodwill, total share is 14,000, but he is bringing only 8,000. 6,000 he still needs to be 6,000 is still pending with C as premium for goodwill. Right? The second point is depreciate furniture by 10%. Then half of investment means 20,000 investments was to be taken over by A and B in their profit sharing ratio. Which profit sharing ratio? The question is, in which profit sharing ratio? Friends, this balance sheet is before the admission of a partner, and before the admission, anything which belongs to old partners in old ratio. So this half of investments that have been taken over by A and B will be there in old profit sharing ratio, and the remaining half to be valued at 26,000. What are the remaining half investments? 20,000. Those 20,000 investments are to be valued at 26,000. This is revaluation of assets and liabilities, upward valuation of investments. The new ratio will be 3:2. Clear? They ask us to prepare the revaluation account, partners capital accounts and the balance sheet after the cease admission. Let's start. First of all, when you have in the question, when you have anything related to revaluation, I will suggest prepare the revaluation account first. Right? So let's first write down the basics. There are two partners, A and B. They are sharing the profits in the ratio of 3:2, and C is admitted for 1/4 share. Right? And what is the new profit sharing ratio? Is 3:3:3. New profit sharing ratio is 3:3:2. Right? Why we need this new profit sharing ratio, you will get to know. Because we have the goodwill treatment. In the goodwill, we will need the sacrificing ratio. For the sacrificing ratio, we need old ratio and new ratio. Let's first of all prepare the revaluation account, because we have some revaluations. First of all, prepare the revaluation account. Please prepare these accounts in proper format in exams. Okay? Be very careful with this, because I am concentrating more on concepts. You know the formats, you know how to prepare the accounts. Okay? Let's see. Revaluation. What is the first revaluation? He says depreciate furniture by 10%. The asset is to be reduced by 10%. Furniture is 30,000 and 10% is 3,000. Now the asset will be debited or credited. If we have to reduce the value of an asset, what will you do? You will credit the asset, I'll say, to furniture 3,000. Next, half of investments was taken over by A and B. Half of investment means 20,000. There is no revaluation regarding this part. And the remaining valued at 20,000. What is the remaining investments? 20,000. This remaining is valued at 26,000. There is an upward revaluation of an asset, and this we will record in the revaluation account as by investments 6,000. Is it clear? See, total investments are 40,000. Out of this 40,000, 20,000 is taken by A and B. What is the remaining part? 20,000. This remaining 20,000 is valued at 26,000. There is a 6,000 upward revaluation of asset. So what is the profit? Now the profit will be transferred to whom? The profit will be transferred to old partners capital accounts. In which ratio? That is very, very important. In which ratio the amounts are to be distributed? That is very important. In old ratio, the total profit is 3,000. Sorry, this will be 1,800 and 1,200. Clear? So this is our revaluation account. Now, we need to prepare the partners' capital accounts also. Right? Let's prepare the partners' capital accounts. Please follow proper formats in exams. Okay. So we have 3 partners. A, B and C. Okay, I have a lack of space, so I'll just keep it short. Okay, so debit and credit. Particulars A, B, C. Particulars A, B and C. Now, what is the opening balances? By balance brought down. For A and B, we have the opening balances as 70,000 and 60,000. And for C, we have to calculate how much capital he will be bringing to make the capital of all the partners proportionate to their share of profit. Is that clear? Now, we will first do this revaluation thing. We have already identified the profit that needs to be transferred to the partners' capital accounts. Clear? So I will say by revaluation account, $1,800 and $1,200. Clear? If you see in the balance sheet, there is a journal reserve of 20,000 appearing on the liability side. What to do with this? What is a reserve? Profit. Part of profit only, and any reserve that is appearing in the balance sheet before the admission of a partner is to be distributed among old partners in old ratio. So distributed. I will say by reserves. How much? 20,000 is to be distributed 12,000 and 8,000. In which ratio? In old ratio. Be careful. Okay. Now, what is the point left with us? We have done the revaluation thing. What we are left with is goodwill and the capital. Capital we cannot find out because we have to adjust the goodwill first. Then only we will be able to get the adjusted capitals of old partners. One more point here. Investments taken over by A and B, 20,000. We will record here as 2 investments because the asset is being taken over. We will reduce the asset, and for reducing the asset we need to credit the asset, and the capital accounts of the A and B will be debited with rupees 12,000 and 8,000. Clear? Now the goodwill part, very important. He says he is bringing 8,000 for goodwill. He is bringing 8,000 as goodwill. First of all, treat this much part. Leave this out of his share of 14,000. 8,000 he is bringing. The part which he is bringing is to be distributed among old partners in which ratio? Sacrificing ratio. So first we need to calculate sacrificing ratio. I'll say working note number 1, calculation of sacrificing ratio. What is the sacrificing ratio? This is old share minus new share. What will be the A's sacrifice? What is the old share? 3/5. What is the new share? New share is 3/8. So this comes to 9/40. For B, the old share is 2/5 and new share is 3/8. This comes to 1/5. 40. So we can say the sacrificing ratio is 9:1. Now see the question. 8,000 will be distributed in which ratio? In the sacrificing ratio of 9:1. Let's do it. We'll say by premium goodwill. The 8,000 that we are distributing among the old partners in sacrificing ratio, the amount will be 7,200 and 800. Clear? 7,200 and 800. Clear? Now, he says the total share is 14,000, but he is bringing only 8,000. What to do with the remaining 6,000? Sir, debit the new partners' capital accounts and credit the old partners' capital accounts. Sir, absolutely wrong. I told you in the last lecture, in case of goodwill and in case of adjustment of capitals, if the new partner is not bringing his share of premium for goodwill, then that will be adjusted through the new partner's current account. Clear? That will be adjusted through the new partner's current account. So 6,000 share of goodwill not brought by new partner, the journal entry will be C's current account debit and the old partners capital accounts will be credited because they will get the money. B's capital account. The amount will be 6,000 and sacrificing ratio is 9:1. So this will be 5,400 and 600. In the capital accounts, we will write by C's current account. How much? 5,400 and 600. Clear this much? This is very, very important to understand. Very important to understand the part of goodwill. Any goodwill not brought in by the new partner, in case of adjustment of capital, it has to be treated through the new partner's current account and the old partner's capital accounts. This is one major point in this question. Otherwise, there is nothing in this question. You can prepare the revaluation account, you know how to calculate the sacrificing ratio. Now, we have distributed the journal reserve. Right, we have distributed the revaluation, premium for goodwill done, current account done, and investments done. Now calculate the balance of the A and B. We have to calculate the balance of A and B. Why we need this? Because to calculate the amount of capital to be brought in by C. What is the balance? The balance comes to 84,400 and 62,600. Clear? Now we will calculate calculation of capital to be brought in by C. Right? First step, let total share be 1. What is C's share? 1/4. at the top of, I told you C's share is 1/4. What is the remaining share? What is the remaining share? 1 minus 1/4, 3/4. What is the adjusted combined capital of A and B? Adjusted combined capital of A and B, this is going to be this 84,000 and 62,600. This is the adjusted. After all these adjustments, what is the capital of A and B? That is the adjusted capital, adjusted combined capital of A and B. This is going to be 84,400 plus 62,600. This comes to 1,47,000. Right? Now, for this 3/4 share, the combined capital of A and B is 1,47,000. We can calculate the total capital of new firm. That will be the combined capital of A and B multiplied by reciprocal of shares. This comes to rupees 1,96,000. And out of this 1,96,000, the C will bring capital proportionate to his share of profit. The C's share of capital will be 1,96,000 multiplied by 1/4, rupees 49,000. Clear? So this is the capital to be brought in by C. Here we'll say by cash 49,000 and balance carried down as 49,000. So you can total this out. Okay. So this is how we calculate the capital to be brought in by C. We have to do all the working first. We have to do all the adjustments first, and then we will be able to calculate the capital to be brought in by C, because we need the adjusted capitals of old partners A and B. Clear, friends? Is it okay? Now, let's prepare the balance sheet. Let's prepare the balance sheet of this. Balance sheet after the admission. Okay. So we have the liabilities, amount, assets and amount. Let's see one by one. Machinery. Anything related to machinery? No. It will appear at 66,000 only. Machinery at 66,000. Next. Furniture 30,000. Yes, furniture was depreciated by 10%. So the new value of the furniture will be 27,000. Furniture, the new value will be 27,000. Investments, yes, half of the investments are taken over by partners and the remaining half is to be valued at 26,000. So the investments will appear at 26,000 because the remaining half we have adjusted through partners' capital accounts, right? Next, debtors. Anything related to debtors? No. The debtors will appear as such. So we'll say debtors of 38,000 minus provision of 4,000. So that debtors will appear at 34,000 only. Okay. Next, cash. See, cash is 24,000. Is he bringing anything in cash? Yes sir. Goodwill of 8,000. Anything else? Yes sir. Capital of 49,000. So your cash will be 81,000. Anything else to appear on the asset side? Yes sir. C is current account. For the goodwill part not brought in, we debited the C's current account. He is our debtor. We have to recover the money from C, which is debited to the C's current account. So here I will see the C's current account as 6,000. Right? Is there anything else? Yes, there is one stock that we left, 46,000. Sorry. Stock will appear as such at 46,000. Now the liability side. Capital accounts. Yes sir, we have the capital balances. Capital accounts. A 84,400, B 62,600 and C 49,000. So the total comes to 1,96,000. Sir, what else? Journal reserve we have distributed among the partners. Bank loan, yes sir, it will appear as such. Bank loan of 18,000 and there are creditors of 72,000 which will also appear as such. Now this should tell you your balance sheet. The total comes to 2,86,000. Clear? How to prepare the balance sheet of the new firm after the new partner's admission. Clear friends? All the values will be taken at revalued amounts. After all the adjustments, we can prepare the balance sheet quite easily. Right? With this, we wrap up this chapter of admission of a partner. Okay? And in the next lecture, we'll start with the new new chapter, that is retirement and death of a partner. Right? Before that, I will suggest go through change in profit sharing ratio, go through admission of a partner, goodwill, all the chapters. If you are clear about the concepts of all the previous chapters, then this chapter of retirement and death of a partner is going to be very, very easy. Right? So I will suggest friends go through the previous chapters, previous lectures first, and then this retirement chapter will be very easy. In the next lecture, we'll be starting with the retirement chapter. Right? So that's all for this lecture. Thank you friends.